Hey, friend, welcome back to the Live Off Rent Show, where we bring you real estate and other financial experts to help build passive income, create your dream lifestyle, reach financial independence. As always, I'm your host, Brian Davis, co-founder of Spark Rental, and I'm on this journey with you. And we bring in guests who are also on this journey with you. So on that note, I am super excited to introduce Chris Seveney. He's a real estate investor. He's the founder of 7E Investments. That's number 7, letter E Investments, a play on his last name, of course. It's a private equity firm specializing in distressed mortgage notes. So, Chris, welcome to the show.
Brian, thanks for having me. Ecstatic to be here today, and always love talking shop, talking real estate.
Amen. Well, Chris, we love to have all guests just take us back to the beginning of how they got into real estate in the first place, what went wrong, because usually there's a lot that went wrong. I know there certainly was for me. So yeah, take us back to the beginning, how you first got into real estate investing.
Yeah. So, man, the interesting part when you mention that, it's like, wow, what went wrong? We could talk for days on that. So how did I get into real estate investing? Great question. And I didn't get into real estate investing until I was in my late 30s. So everyone who's sitting there like, oh my God, I need it 22 years old, got to get in. You don't have to. I mean, I wish I did. But I got in, and it's interesting because I had my boss yell at me, actually, is the way I got into real estate. I had spent 15 years working for a general contractor and large commercial, building huge projects, 300 unit apartment buildings, all really cool, fun projects. But you're working like 5-6 days a week doing that. So you don't have time for your own personal portfolio. Then I went to the dark side, which is a real estate developer. And my boss at the time, basically he owned, and this is in Washington, D.C., he owned a bunch of rentals in San Diego. And he's like, you got to buy California. Everyone's leaving, but I'm telling you, California. And this is 10 plus years ago. And I'm laughing at him like, yeah, right. And he's like, what do you own for real estate? I'm like, I'm building my primary residence. He goes, you don't own anything? I'm like, no, why? He's like, oh, you're a 40 guy. And I'm like, what do you mean? He's like, you're going to work 40 hours a week for 40 years to get 40% of your paycheck and then realize I probably should have invested in something else.
Love that.
So that was the wake-up call that after we built our primary residence, we had equity, we took out a line of credit and started buying some rentals in the Washington, D.C. area to rehab.
Wow. D.C. Okay, so I'm actually from Baltimore, so not far up the road from D.C. Mm-hmm. D.C. can be a challenging market, but you have a very consistent job basis there, right?
So absolutely. So for rentals, so I have, and if you're from Baltimore, you'll probably know. So I have one rental in Montgomery County, Maryland. Okay. And then I had another one that was out in like Loudoun County, Virginia. And those are probably, from a political standpoint, being so close to each other, complete ends of the spectrum in regards to rental restrictions and everything that goes into play.
So, and those are single-family rental properties from the beginning of when you started investing in real estate?
Yeah, so we started, buying. We started buying several rentals. We rehabbed them and then did the BRRRR strategy of refinance them and keep going. And early on,
just break that acronym down for anyone who's not familiar with it. It's a great strategy.
Yeah, you buy the property, then you rehab it, then you rent it, and then you refinance it. So here's a perfect example. One of them we bought was an off-market condo that we paid, I want to say like 70 grand for. We put 20,000 into it. It appraised at about 125,000. So we're in it for 90, appraised for 125. We took a $90,000 loan. So we got all of our money out. And then the rent covered the payment. So our, some people would say it's infinite return because I have no money in this deal. Now, 10 years ago, even 5 years ago, when interest rates were low, that was a great strategy. It's much tougher in today's higher rate environment.
Oh, yeah.
So, so that's how I started. And I kept doing that until we had 2 kids at the time as well. And they were starting to get into sports and everything. And my wife was like, we can't keep spending weekends rehabbing properties. We have a family. Yeah. So that is when I kind of spun into what I do now, which is note investing.
Yeah, so take us through that transition because a lot of investors get into real estate investing with single family rentals or flips. Maybe they work their way up to small multifamilies, still 4 units or under because they're still classified as residential and you can still get the conventional mortgages. Then maybe they get a small commercially zoned multifamily, 5 to 10 units, kind of work their way up that way. But so you went maybe in a different direction here. So anyone who's currently investing in residential properties and thinking about taking that next level up, walk us through that transition for you.
Yeah. So I still own rentals. So I am 100% a believer in a diverse portfolio. You need to do what fits you. Don't just follow. I'm not just going to follow Brian because he's awesome and he knows how to do it.
I mean, you could.
You could, yes. But you also got to make sure it fits what you do. So I just want to kind of start with that because people, sometimes like when people do other types of asset classes, like, oh, you shouldn't do that or you shouldn't do this. Well, how do you know what that person's situation is? So I just
there's no right or wrong answer.
Yeah, there's no right or wrong. And I came from the background of building condos, doing multifamily, owning, and also owning rentals and trying to be more passive. And, from that standpoint, for me, for the time that I had and also spent with my family, that is where I made that decision to say, okay, I'm going to start now moving into the more distressed mortgage note space because that can be done from anywhere on the planet, as long as you have internet and at any time during the day, because you don't need to go to a showing of an off-market house between 1 and 3. On that, you are literally, it's almost like buying commercial real estate where, there's a package put out, they want bids by a certain date, and then you just provide your proposal by that date. It's not like a first come, first served type of situation.
Well, you're speaking my language, talking about investing from anywhere in the world. I'm recording this from Lima, Peru, where we're currently, home based in. So
kind of not liking it right now, Brian. So I'm going to take back what I just said about, you being awesome and stuff like that. So,
well, you guys have you might have bad weather right now, but in come July, it's going to be gorgeous weather where you are, and it's going to be cold and wet and dreary here in Lima. So don't get too jealous. But yeah, so I love the strategy that you guys are doing at 7E Investments with the distressed mortgage notes. But walk us through. So I happen to have had many conversations with you about what you guys are doing. But for our listeners here, walk them through your exact strategy of buying some of these distressed notes and then getting them to actually perform. Because a lot of people, when they think about buying distressed mortgage notes, they think, oh, you're going to have to foreclose on a lot of those, and that's expensive and it's time consuming, and you have to live with the fact that you're kicking people out of their homes and all that stuff. But you guys actually have a very good track record of turning these around. So yeah, anyway, walk us through your strategy with these.
Yeah, so that's that in the first question people ask is, well, how do you make money on a mortgage that people aren't paying? And the way we like to explain it is, most people are familiar with fixing and flipping real estate. So that's kind of the analogy we like to use. Whereas instead of buying the property, we're buying that person's mortgage. So most people, when they buy a house, they get a mortgage on it. And if you've ever gotten a letter in the mail that says, now send your payments to this company, your mortgage has been sold. Now, you probably don't even recognize or know who it's been sold to. You just look at, okay, here's where I now need to send payments. But it could be that 7E Investments may have bought that mortgage and collected your payments. Now, when you're buying, distressed defaulted mortgages, the borrowers are typically behind. And what we like to focus on is borrowers who didn't wake up one day and said, I'm not going to pay my mortgage today because I just feel like I shouldn't. And most people don't. Most people have health, job loss, divorce or death or something happens in their life. And we will go in, and I'm just going to use some numbers as an example because people sometimes can, listening, visualize numbers. Yep. If you owe Brian $100,000 on your mortgage and you are 2 years behind, and when people say, oh my God, you're 2 years behind, the average delinquency that we see is about 3 years. So people are 3 years behind on their mortgage. People, when you think you're going to miss one payment, they're going to come lock you up and throw you out. That doesn't happen. That can't happen legally. So you're 2 years behind on your mortgage and you owe $100,000. That lender may look to sell that loan. So, and we're just going to say for simple numbers, your payment's $600 a month. We're going to step in and we'll say, okay, we'll buy that loan for $60,000. Okay. So we
so
just
a deep discount
a
off of
40%
what's actually owed
discount.
on it.
And you're 2 years behind. So let's say overall, that's $15,000 roughly behind on payments. A traditional lender is going to say, Brian, unless you give me $15,000, don't call us back.
Right.
Okay. We'll say, Brian, can you give us $5,000 down? And then if you can make your payments for 6 consecutive months, we'll restructure the loan to take all those missed payments and we'll bundle it into a new loan. I'll say recast the loan, or so your payment still stays at 600, but basically it extends a period, or work the numbers.
Right. So if you have 25 years remaining on your mortgage, now you have 26 years remaining on it, or something like that. Yeah.
Correct. Yep.
But the monthly payment stays the same.
Yeah, we try and keep that monthly payment the same, or again, make it affordable for that person, because they may come back and say, okay, can I pay a little more, or I can't afford this, could they pay less? And then that will also impact kind of values and what we do. But people, and in today's environment, or let me jump back and go back to that situation. So if I get you to give me $5,000 down and then $600 a month, now I just got 12%, initial upfront payment because I paid 60. So 5,005 divided by 60 is 12%. And then I'm getting $7,200 a year, or another 12% on top of that. So that, A, is where you start seeing those returns. But then on the backside, that loan is now performing. We might be able to sell that loan where you still owe $100,000. And again, most of your payment is interest. We might now turn around and sell that loan for $85,000. So we take, you think of your basis in real estate of we're dropping our basis, and then we make, additional monies on that back end. Now, to your question, people think, oh my God, you foreclose most of the time. Well, a lot of people jump back to 2008 and just think, oh my God, all the foreclosures, banks taking all these homes. Why was that?
Well,
yeah, as do I. Why was that the case? Well, several reasons. One is people had 80-20 loans, which were they're getting 100% financing, and the values of those homes shot up and shot down so quickly. So that $300,000 home was only worth $250,000, and the people couldn't afford it, or they just didn't want it, so they were walking away. So that was 2008 to 12. The loans we buy are typically from like 2014, 15, time frame. So think of where home values were in 2014 compared to today. If you could take your crystal ball and go buy all the real estate you want in 2014, knowing what you know today, would you?
Oh, of course.
If anyone listening to this says no, then I don't know what to say.
Build me a time machine. Let's do it.
So think about that though, where Brian, you bought a $300,000 house in 2014, and let's say you put 10% down. So let's say you owed $280,000. A house today, let's say conservatively, is worth $400,000, and you paid your mortgage down. So if you owe $250,000 on that house and it's worth $400,000, are you going to let it go to foreclosure?
Not intentionally.
No. So when people think, today, especially if it's your own home, because where are you going to move to today? Can you buy a house? Not in most markets.
It's a lot harder than it was in 2014.
Yeah, and how much are
and
rent?
Interest rates are a lot higher.
Yeah, and how much are rents today compared to what your probably mortgage is from 10 years ago?
Right.
About the same. So that's why when people think you're going to foreclose, it's rare. Like, we've spoken in the past, under 10% of the time we actually foreclose on a property. And that is primarily because the borrower is deceased. So there's no way for them to pay, or they've moved out and they just don't want that property. And we would know that. We would know that up front because the house is vacant. And we would probably not buy that loan anyway. So
right, because you guys don't want to foreclose. It's very expensive to hire a law firm to foreclose. It takes a long time, and then you can't turn around and sell the loan to someone else as your preferred exit strategy. So speaking of which, out of curiosity, how long do you typically hold these loans before you turn around and sell them?
About 12 to 18 months is a typical hold period, and our goal is try and get them to come to the table as quick as possible so we can negotiate with them. show they have a history of being able to pay again. And once they're able to show that history of consistent payments, then we'll turn around and try and sell that on that secondary market. Or sometimes we'll try and work with them to refinance if they potentially could get a lower interest rate. That was 2-3 years ago. That was huge where we could help people refinance.
Yeah, I was going to say that sounds like a great strategy for 2 years ago. Maybe not so much today. So along those lines, how have the higher interest rates of the last 2 years impacted your business?
Yeah. So from a primary impact, I'd say it's had very little impact because we are a debt fund where we're not leveraging or taking money from banks. So we're not paying, like most people think of my rental. If I'm on a variable rental rate, oh my God, my mortgage increased, so my payment increases. So we don't have debt that we have to pay off to people. So that's one area where it doesn't impact us. But the second
You guys
area,
don't borrow any money at all.
yeah, we have no money borrowed. We have investors who are preferred equity. So we don't have to worry about
the risks low.
Yeah, it keeps our risk low. And when you think about it on the non-performing side, let's go back to that loan from 10 years ago that they owe 250. The house is worth 400,000. We're buying it at a discount. That interest rate is fixed. So that really doesn't have an impact on the value of that loan. What has the impact is like if foreclosure timeframes take longer or shorter, because we're looking at time value of money. So interest rates, interestingly enough, do not have a big impact. Now, secondary impact is what you mentioned a few years ago, the exit strategy, where previously we could work with borrowers to try and get them to refinance. That today is not really a primary exit strategy. It's either we sell the loan, or the other exit strategy is the average person lives in their home for about 7 years, which today, because of the high interest rates, we're not seeing that as much. So, where we do see, interestingly enough, though, people with some of the refinances they're trying to get money out. So on this $250,000 home, they fell behind, but now they can afford it, and they try and get caught up. Then they'll try and refinance it, maybe get 300,000, so they can pay off their credit cards or pay off some other debt, try and lower their monthly payment.
Gotcha. Well, I love the strategy, and before I do want to pick your brain a little bit about today's market conditions and what investors should be looking at. But before we do that, before we move away from 7E investments and what you guys are doing, just tell audience listeners how they can connect with you, how they can potentially invest with you if they're interested in this type of investment.
Yeah, thanks. So they can go to our website, which is 7einvestments.com, or you can email me, Chris at 7einvestments.com. Now, one of the interesting things that I'll say about our fund that is very different from a lot of the other funds that you see out there is I can sit here and talk to people and say, I can accept non-accredited investors. And our minimum investment is only $5,000. So it's not a $100,000 or $50,000 ticket that you need to invest in. It's $5,000 minimum, and that we can accept accredited and non-accredited because we went through what's called the Regulation A+ process with the SEC, which means we just don't have to file a form saying, hey, we want an exemption. We actually had to file legitimate, the offering circular and the other documents with the SEC to get them to quote unquote qualify us to be able to make this offering available to the public.
Well, you're speaking my language here. We obviously love the lower investment minimum. We love that you accept non-accredited investors. That is exactly what we do in our co-investing club. $5,000 minimum, all investments allow non-accredited investors. And of course, so we have not in our club invested with Chris and 7E Investments yet, but it is something that we are looking at. So, just throwing that out there.
So I need Chris, to call you more often to get you to invest.
I know, right? Well, first of all, I want to be respectful of your time here. But before we let you go, I just want to hear any thoughts that you have about the current risks in the 2024 real estate environment and market, and how you are looking at that market and how you are looking at mitigating risk as either a passive investor in other people's syndications or as an active investor buying properties.
Yep. So full disclosure, I am a passive investor and a limited partner and general partner. So when I sit here and talk, I'm just like everyone else. I invest. I am trying to grow my net worth. I want the fire. I want financial independence, retire early, just like all of us. So it's not like I'm sitting on $50 million and flying private jets or anything like that. I'm just an everyday person like most of us. And for me, being in real estate for 25 plus years, I'm usually a negative Nancy on things. And I think part of the reason why is because I'm on the debt side, I see a lot of things before others people do. And so we see portfolios of multifamily deals that are in default. We see portfolios of self-storage deals that are in default and other types of asset classes that haven't really made its way out there yet. So the one thing I will tell people is, and this is how I operate, is first thing I always focus on is preservation of capital. That is my number one thing I focus on. Is real estate is, slow and steady wins the race, preservation of capital. And here's what I would tell, people, and this is why I tell, my friends, family, is if you think, if you're very optimistic about this year in real estate and you are very aggressive and things go negative, how does that impact you compared to, I'm going to be a little more cautious this year. And if it explodes and I miss the boat, which one is, you'll probably be, either way, you're going to be upset, but one of them would have a much bigger impact on you, I'm guessing, or for most people would. So just be cognizant of that sometimes caution to the wind a little bit in regards to what is out there. When you start looking at, and here's one thing I'll leave with people is, we speak with a lot of asset-based lenders. And these are companies that provide operating capital to equipment companies, just any type of company. And, every time I talk to them, hear what's going on, every single one I have talked to has said, we have stopped lending to anybody involved in real estate. And to me, that is a red flag that they're probably taking on losses that they didn't anticipate, but also a red flag of they're not very optimistic on the market. And they have people, quants and all these really smart people running all these things behind the scenes in regards to what they think. So, just take what I say with a grain of salt, because as we mentioned offline, none of us know. We're just guessing. We're using our magic crystal ball, or like I said, my 21st century fidget spinner or whatever it's called with the things on it. But
which Chris physically has in front of him, by the way, and showed me before the
there you go.
So for anyone who can watch this on video instead of listening.
Yeah, just to bring that full circle again, look at the two outcomes. If you're aggressive and it works, that's great. But if it fails, how does that impact you versus if you're conservative and you don't do anything, does that have an impact on you? Or even if you buy one or two, like what is that happy medium for you? And it goes back to what we started out with. Don't follow the herd. You got to do what's best for you.
Yeah. So, one thing that Chris and I were talking about before we hit the record button is, this is precisely why I dollar cost average my investments. I invest every month small amounts in different investments, and why I diversify my investments, right? So, this month it's an industrial property. Next month it's a mobile home park. The month after that, it's a debt fund or a note. The month after that, it's a multifamily property. I don't have a crystal ball. No one does, right? So I don't know what's going to happen, but I do know that if I keep investing small amounts month in and month out in different cities with different syndicators and different property types, the law of averages is going to protect me in the long term. So yeah, I mean, like you, Chris, I try to bring that conservative, cautious look to it while still continuing to invest month in and month out, because, I can't see the future, but we just try to keep marching forward conservatively.
Yeah. And you said two things there that, people, like if I was taking notes on this, the two things you just said that I would scribble down, write down, and basically put a big star next to is, one, you diversify within real estate. You're just not all multifamily. You're just, you go through all the different asset classes. And the second thing you said was long-term, because let's be honest, you put money in anything today, 10 years from now, it's going to make you money. It's just it might take a little bit longer. It might have its ups and downs like the stock market. But last time I checked, our government is probably not going to stop printing money and pull money out of the system. We're going to continue to print money, which will lead to inflation, which assets increase in value. We could talk a whole show on that. But real estate, long-term wise, and diversification, you will easily be able to ride through any one of those storms.
Yeah, I mean, it's the same. I have the same philosophy with my real estate investments that I have with my stock investments. Dollar cost averaging. Every week my robo advisor pulls money out of my checking account to invest in index funds. Market goes up, market goes down. I'm not going to try to predict the stock market, right? I mean, that's a fool's errand. But over time, I know that the average returns are going to look out for me, and that law of averages will protect me.
You want me to send you one for your stocks?
There you go. Yeah, please, please, send me one of those fidget spinners, like a modern day Magic 8-Ball. I love it. Well, Chris, any final thoughts or tips or words of wisdom for our audience?
Yeah, I think we dropped a lot. Both of us dropped some good nuggets on this episode that, again, just goes back to diversification, long-term play, and again, do what's best for you and never feel like you're starting out too late. You can, whenever you get started is when you get started. Because if I would have started when I was 25 years old, I was immature. I wasn't ready. I wasn't fiscally responsible. It probably would have set me back longer period of time than when I finally had my what together and had the ability to say, okay, I can save money. I know how to manage money and I can do this. And, it's, again, goes back to, do what's right for you.
Well, I did start when I was 25 or 24 technically, and I lost a ton of money because I was so immature and so arrogant and thought I could figure it all out on my own. So, that goes to that proves your point that there's no, you're never too young or too old to start investing in real estate. So, love it, Chris. Thank you so much for joining us today. We appreciate it. We hope to have you back soon.
Thanks, Brian. Great to be here.
And guys, if you enjoy these conversations that we have, please rate, review the show. It means the world to us. And we will catch you next week. Stay in touch. Support at sparkrental.com. Bye now.
Well,
like the idea of diversifying into real estate, but don't want the headaches of being a landlord? Enter passive real estate syndications. You buy fractional ownership in apartment complexes and other large-scale properties. Earn your share of rental income and your share of the profits when the property sells. In fact, most of the syndicators we've invested with have average returns over 20% per year. You even get full tax benefits, including accelerated depreciation. Even as you collect distributions in real life, you often report a loss on your tax return. So why doesn't everyone invest in real estate syndications? First, you typically need to know the syndicator to invest, and the minimum investment for each property is high, usually $50,000 to $100,000. That's a lot of money for a single investment, which is precisely why we formed an investment club to pool funds and invest together. Every month, we propose a new deal in the co-investing club and vet it together on a group call with the syndicator. Each deal is purely optional. Pass or invest as you like. As for us, we invest our personal money alongside you in every single deal. If you want to invest like the 1% without actually being a 1%er, join Spark Rental's Co-Investing Club. Email us at support@sparkrental.com with questions, and we look forward to investing alongside you.